3M stock has been down recently, and in this video I am going to explain why that is, as well as doing an in-depth analysis by looking at the financials of the company, and finally using my Excel spreadsheet to see what price you should pay for 3M stock. This article does a good summary on why the stock is down, and as you can see, is mainly due to these 3 points, and especially the last two, which are that the company's restructuring plans hit an early bump in the road, and the potential legal liabilities still overhang the stock. And I would say the stock is down mainly due to this last point. However, if we take a look at more recent news of today, 3M stock is up 4% because it got an upgrade from an analyst of Bank of America because the legal woes begin to ease. I encourage you to read as many articles as you can and as much as you can on these legal issues. However, I believe this is nothing that affects the fundamentals of the business. And now let's take a look at the financials, which in my opinion are more important. Let's start with the financials of the company and let's take a look at the income statement. If we start with revenue, we are going to see that this is not a growing company. In 2015, they made $30 billion and they are currently making $34 billion. If we take a look in the chart, this is just a very consistent company that is not going to grow a lot over the next years. If we take a look at what analysts are expecting, it's more of the same story. They are expecting a revenue decrease this year, but again, going from $32 billion to $36 billion. So very little growth for this company. If we now take a look at net income and free cash flow of this company, we are going to find the same story with revenue. Just a very consistent company. Look at the chart of net income. It has been the same for the past 10 years. And with free cash flow, we're going to see the same thing. Except during COVID, when it went higher, but this is not normal and we've seen this with other companies. They have the same free cash flow they had 10 years ago. So the fact that this company is probably going to have the same free cash flow, the same revenue, and the same net income over the next years doesn't mean you cannot get a good return on your money. If you buy the stock cheap enough, you're going to make a lot of money. And in order to see if the stock is cheap enough right now, we're going to use the Excel spreadsheet. This Excel spreadsheet tells me at what price I should buy a stock based on the assumptions about the future of the company that I put in, on revenue growth, net income, free cash flow, PE and price to free cash flow, the discount rate, and the change in shares outstanding. I am going to do a 7-year analysis, and let me explain my assumptions before I reveal the prices. Starting with my revenue growth assumptions, we have seen that analysts are expecting 3% growth for this company over the next few years. However, we have also seen that this company has been stuck at $30 billion for the last 10 years and that this year it has been decreasing. So on my low assumptions, I want to be conservative and put -1% in case over the next 7 years they struggle. On my middle assumptions, I'm going to put 1%, which is what I believe the company is going to do. And then for my high assumptions, 3%, which is what analysts are expecting. Now, if we move on to profit margin is based on net income, and we have seen that it is super consistent. So obviously, profit margin is also super consistent between 15 and 16% for the past 10 years. So on my low assumptions, I'm going to put 15%, middle 16%, and high 17%. Then for free cash flow margin is also very consistent, except for this year, where they have 11%. So on my low assumptions, I think 11% is not normal and they are going to go back to 15-16%. But just in case, on my low assumptions, I'm going to put 12%. And then for my middle and high assumptions, I'm going to match profit margin. Then for PE and price to free cash flow, the average of the stock market is around 15%. And you should assign a higher or lower PE depending on the growth of the company. And obviously 3M doesn't have a lot of growth. So on my low assumptions, if the company is only going to grow -1%, I want to assign a very low PE of 10, middle 12, and high 14. Then for the discount rate, which is the return you want to get each year on your investment. You can get between 8 or 9% investing in an ETF. So if you take the risk of investing in an individual stock, you should put a higher return. And I usually do 10, 12, and 14. However, we have seen that there are some risks when investing in 3M. So I'm going to put just a higher desired annual return of 11%, 13%, and 15%. And finally, in terms of shares outstanding, we are going to see that they do buy back some shares every year, usually. So I'm going to be conservative and I'm going to put that they buy back 1% of their shares every year for the next years, although we are seeing in the chart that it is a bit more. So now let's reveal the prices. As you can see, according to my Excel spreadsheet, 3M looks pretty good in terms of valuation, as according to my middle assumptions, you would make a 13% return on your money every year for the next 7 years, which is very good, not including dividends. And according to my high assumptions, you would make like a 19% return on your money for the next years. However, if you believe the low assumptions, the stock price needs to fall a little bit more. I also want to say that this Excel spreadsheet does not take into account the balance sheet or their dividend. So let's quickly take a look at that. Company currently has a 5.8% dividend yield, which is pretty high, and the payout ratio is 61%. However, with the issues that they've been having, I believe that the dividend yield might get cut in the future. So you have to be okay with that when investing in this company. Then, if we take a look at the debt, which is the difference between the market cap and the enterprise value, we can see that there are $13 billion of debt. But for such an established company like 3M, this does not worry me at all. The question you need to ask yourself when investing in 3M stock: is the valuation worth it, considering all the issues that the company has at the moment? And the answer to that question for me is no, because I believe the market as a whole is overvalued. So I believe with the issues that the company has, and with the possible future dividend cut incoming, I believe I'm going to get the stock a lot cheaper in the future. However, if these were normal market conditions, I would buy the stock. But as always, you need to do your own analysis and do your own research. I hope you enjoyed the video, and I'll see you on the next one.